I would fully expect the dollar to be in serious decline. Between 1983 and 2002, I reckon, looking at those flows and all the rest of it, and contemporary prices, and remember we had a massive bear market in gold, which took it down to under $300 in 2002. I reckon that China could have accumulated by then something like 25,000 tons of gold. There are various other indicators that she had been doing this, such as her policy towards gold. None was allowed to leave the country, and it's still the case. And furthermore, she invested very heavily in mining capacity and refining capacity, so much so that China rapidly became the largest nation by mine output.
China has been consistently accumulating gold for 14 consecutive months, establishing itself as the largest buyer of the precious metal in the past year. Recent data indicates that in December 2023 alone, China added 9 tons of gold, 290,000 ounces, to its reserves, bringing the total for 2023 to 225 tons, resulting in the People's Bank of China holding 71.87 million ounces of gold. Alasdair Macleod, head of research at Gold Money Incorporated, suggests that China, known for its cautious approach, may explore the possibility of a gold standard. Since 1983, China has steadily increased its gold holdings, making it the largest gold-producing nation. However, whether China will officially adopt a gold standard remains uncertain. Global central banks, responding to the geopolitical sentiment towards the US dollar, have witnessed record gold buying as a defensive measure. In 2023, central banks globally purchased a record 374.1 tons of gold, as reported by the World Coin Council. Macleod notes that countries are considering the gold standard not as a proactive choice, but as a response to safeguard against changing economic conditions. Major currencies within the BRICS bloc migrating onto gold standards, most likely starting with Russia and then China. The initial move to a gold-backed trade currency is likely to undermine the dollar's purchasing power. For instance, in the case of Russia, there is a move to tie the ruble to gold, aiming to make the currency independent of US dollar comparisons. This involves requiring countries to use the ruble for major exports and increasing the amount of gold held by Russia. We will present clips from Alasdair Macleod interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Rather than making countries thinking they should consider a gold standard, I think for most of them it's a question of protecting themselves against the changing conditions which are obviously happening. I mean, we're moving away from the sort of the post-Bretton Woods era into what Zoltan Pozsar called Bretton Woods 3. In other words, there's a new era coming, which at the very least is going to look like the 1970s, with instability in terms of purchasing power for fiat currencies. And I would agree with that. And I would say that there is an increasing likelihood that this leads to the collapse of the fiat currency regime entirely. But let's not go there for the moment. As to your question as to whether other countries are considering a gold standard, I have no doubt that China is considering this as well. But China does not. It takes a sort of evolutionary approach to matters. She doesn't sort of rush out and suddenly do things, as it were. Her strategy basically is to let others make mistakes. And America has been making all the mistakes, and China just sort of sits there. Nothing to do with us. We're just running our own affairs. And that's the sort of Confucius approach, if you like, Confucian approach, which actually is very much in the government psyche. I reckon that since 1983, when they first started accumulating gold, because they appointed the People's Bank specifically to do that, and I've got the original articles, which I'll put on my Substack, actually, it's a good idea. The original legislation appointing them. Now, what they did basically was they controlled the foreign exchange flows because no one in China could buy foreign currency. So everything had to go through the People's Bank. They siphoned off some of that. You had capital inflows in the 80s, and then you had increasing exports. So you had a balance of payments bringing in foreign currencies. So Between 1983 and 2002, I reckon, looking at those flows and all the rest of it, and contemporary prices, and remember we had a massive bear market in gold, which took it down to under $300 in 2002. I reckon that China could have accumulated by then something like 25,000 tons of gold. Now, there are various other indicators that she had been doing this, such as her policy towards gold. None was allowed to leave the country. And it's still the case, incidentally. And furthermore, she invested very heavily in mining capacity and refining capacity, so much so that China rapidly became the largest nation by mine output, gold mine output. This tells me that they do understand that gold is money and the rest is credit. They understand this at the highest levels. I mean, don't ask President Xi, ask his advisors.
The US national debt has reached a historic milestone, surpassing $34 trillion this month. This development raises concerns about the sustainability of the growing debt burden, especially as large deficits are expected to persist. In fiscal year 2023, the federal government recorded its third largest deficit in history, totaling $1.7 trillion. Alasdair Macleod emphasizes the challenges faced by central bank officials, including Jerome Powell at the Federal Reserve, who must be dealing with sleepless nights. The surge in government debt, coupled with a declining economy, adds to the mounting difficulties. Despite the Federal Reserve's access to information through regional offices, Macleod notes that the central bank is observing an alarming economic landscape. The recent intervention to rescue regional banks from bond losses underscores the severity of the issues at hand. Regional bank stocks experienced a surge after the Federal Reserve hinted at potential rate cuts next year, bringing regional bank ETFs back to their levels before the collapse of Silicon Valley Bank. Let's get back to the interview.
The reality of the situation is that the situation is getting beyond anyone's control. And, the officials in any central bank are having, they must be having sleepless nights as to how to deal with this upcoming situation. Just imagine that you are Jay Powell in the Fed. What do you see? Forget the statistics and forget the propaganda that you put out and all the rest of it. But the truth of the matter is that you're seeing debt getting out of control, government debt getting out of control. They have, the Fed, through its regional offices, has a pretty good grasp of what's going on the ground around the country, though it doesn't necessarily tell you what it knows. This is the information which it needs to inform itself. It can see that the whole thing is going down. It knows the situation with the banks, which is why it had to rush in and rescue the regional banks from the losses on their bond positions. What bank actually in the old days would buy bonds with a maturity of more than 1 year? This is just complete lunacy. But you had, with zero interest rates, everybody was misled, including the Fed itself, incidentally. Because, one point I would agree with you on is their grasp of economics and grasp of the difference between money and credit is perhaps sadly lacking. Their grasp of the role of interest rates is definitely lacking. These guys are in real difficulty. As to the debt trap, well, you're holding this interview from Japan, while I'm in Britain. The Japanese government has got something like, 260% debt to GDP, and the central bank is underwater big time with its positions in not just short-term government debt, but also long-term government debt, 10-year JGBs and even 30-year JGBs. I calculated at one stage, when I think when the 10-year yield was up about sort of 0.75%, that the negative equity on the Bank of Japan's balance sheet was something like 4,000 times its capital. So the whole system is actually in enormous difficulties. And if you look at the Japanese commercial banks, many, many years of trying to create profits out of a situation of negative interest rates means that they have increased their leverage in order to generate a reasonable bottom line. So that leaves them over, with a debt to equity ratio of over 20 times. This has never been seen before. It is that serious. So, the debt trap, basically, it's one thing, if you've got, say, 260% debt to GDP, and you keep interest rates at zero, which incidentally is why they're at zero. But anyway, we'll just gloss over that point. That's not a problem. But as soon as they start rising, Houston, you got a problem. And we're seeing this not just in Japan, not just in the Eurozone, but also in the United States. I wouldn't be surprised to see US Treasury debt approaching the 40 trillion level at the end of this calendar year.
The Federal Reserve's recent intervention, indicating economic challenges, led to a surge in regional bank stocks following hints of potential rate cuts. Simultaneously, global central banks, including Russia, are contemplating gold standards as a defensive move amid changing economic conditions, aiming to weaken the purchasing power of the US dollar. What are your thoughts on these growing global trends? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.